Good afternoon, everybody. I know you think taxes is going to be boring. Well, I can make it exciting. How's that? Now, I think Tom said there's a number of you guys are a lot of you are from here. I know you're not from here, Doc, Michigan, but everybody else from here? California. You drove in for this? Partially, okay. Okay, all right. Okay. Well, just remember, too, when you go to see your CPA, you can write it off as a tax deduction, can't you? That's what I'm thinking. Is the mic working okay? Okay. All right. So as Tom said, and I know, Doc, you said you've seen me before, and you saw me before. I worked for the IRS for 33 years. I was really famous. I really was. I started right out of college. And I wasn't actually that book smart, by the way. I was street smart growing up in South Philly. So, of course, it was easy for me when I went out to do audits. I knew what I would do if I was them. So it was pretty easy to find. And over the years, I worked my way up at IRS. I was a manager for far more than half my career. They used to give me the high-profile audits. Muhammad Ali was one of my audits. I was big in the car industry. I put the oldest Chevrolet dealer in Philadelphia out of business. So I was really good at this stuff. And then eventually, I got into large corporate audit, and I was just as good at large corporate audit. And so any Fortune 500 company that was in the Philadelphia area, I probably managed the federal tax audit of, Cigna Insurance, Bell Atlantic before they became Verizon. And I was really good at that, too. In the year I retired, I was like the #1 employee in the nation in large corporate audit. So I was really good. But I was telling this gentleman, I decided to retire, moved out here, got bored, unretired. I lasted about 2 months, I think. Turns out I hate golf, which is big out here, and I suck at gambling. How's that? And by the way, gambling is actually not a good investment if you haven't figured that out. Yeah. Just, if you want some great investment advice, don't gamble. How many of you are in business for yourself? Okay. All right. Without a doubt, a really challenging year for business taxes. And let's talk about a couple easy items, and then we'll talk about the more complicated ones. Anybody out here invest in real estate? Own any property? Okay. Well, many people who invested in real estate, okay, when they wanted to sell their property, instead of having to pay the tax, they could buy another property and defer the gain on the sale. They would refer to it as 1031 exchanges. You've heard that before? Okay. Still very popular. Okay. Still okay. 1031 exchanges are pretty good, all right? They would refer to it as like a like-kind exchange. But here's another like-kind exchange you never thought about. How about you trade your car in? You have a business automobile, and you trade it in. Well, under the old law, they would consider that a like-kind exchange. And what that would mean is that if you had already depreciated your business vehicle, okay, you didn't have to report the gain. What would happen when you traded it in? They would just reduce the basis of your new car. It's pretty simple. Under the new tax law, like-kind exchanges only apply to real estate now. There is no more like-kind exchanges on anything else. So when you trade in your business vehicle now, it counts as 2 transactions. One, you sold the old car or truck, and so if it was fully depreciated, you'd have a gain you'd have to report, and then you get to depreciate the new vehicle, whatever you paid it for. Does that make any sense? Not a big deal, but again, it's a big deal because what if you had an expensive vehicle and you traded it in, and say you got $30,000 or $40,000 on the trade-in? Say you had a Maserati, a Mercedes, was it a Maybach? You ever see those? The Mercedes dealer used to be right down the street from us, yeah. I heard, though, if you buy one of those, you have to buy a driver that goes with it because it looks kind of corny if you're driving it yourself. It looks ridiculous driving it yourself, yeah. So, yeah. So you have to, so that could have a tax impact. And by the way, here's another thing. I don't know if you've ever noticed. You being doctors, I'm sure you get all these professional magazines, right? You ever notice toward the end of the year, you see all these ads for vehicles, especially high-priced ones like Land Rovers? And if you've ever read the ads, they tell you if you're going to buy a car for business and you buy it before the end of the year, depending upon the vehicle you buy, there's certain attributes that could go with it. And here's the way this works. If you buy a vehicle for business that has a gross vehicle weight of 6,000 pounds or more, and I'll tell you what gross vehicle weight is, they treat it as if it's a truck and not a car. Gross vehicle weight is a combination of how much the darn car weighs, how much the passengers weigh if all 4 people are sitting in there, and how much all the liquids in there, like the gas tank. So if it's a full gas tank, if you add all those up, now again, you don't have to figure this out. The car dealers already know, trust me. If it's 6,000 pounds or more, it's treated as a truck. And if it's treated as a truck, you literally can write off the entire car in 1 year. Or, I'm sorry, the truck, sorry. But they passed this one law in 2018, which was really good. And what it said was, if you're in business for yourself, instead of having to pay tax on 100% of your profits, you only have to pay tax on 80%. What a country. Is this unbelievable? This is unbelievable. So if you made $100,000, instead of paying tax on $100,000, you only had to pay tax on $80,000. Is that unbelievable? What a deal. Now that sounds pretty simple, right? But if it was simple, I'd have no job, okay? I personally was hoping they'd make the tax law more complicated myself, but just saying, you know, the more complicated, the better. You need me. And when it comes to this new law, and when it comes to tax preparation in general, okay, but when it came to this new law, you would not believe how many CPAs messed this up. You would not believe how many people messed this up because they didn't understand it. I am not making this up. Both I and my partner Gary, each of us, and we saw a lot of mistakes. I looked at this one guy's return. He was off by $150,000 in tax. I didn't say as a deduction, in tax. And Gary did one the same way. I've seen more mistakes by other CPAs and accountants this past year than I've probably seen ever. I mean, accountants always mess stuff up. Well, not us, of course. We're different. I've seen alternative minimum tax messed up because accountants didn't know how it works. But this new tax law was incredible how many mistakes they made. So what did I say? I said if you're in business, instead of having to report 100%, you only have to report 80%. However, what if you had rental property? And what if your rental property showed a profit for tax purposes? Now, again, keep in mind, oh, by the way, I am a licensed real estate broker. But let's make believe, you know, many times people who have rental property, generally they show losses for tax purposes. They don't usually show gains. But if you had the property long enough, it could show a gain. Or say you paid the mortgage off, it could have a gain. If you have a positive profit on rental property, that counts for the 20% too. You know how many people missed that one? A lot.